So imagine celebrating a 30.4% surge in top-line revenue.
Right, which sounds incredible.
Yeah, exactly. You're parading this $1.7 billion quarter in front of Wall Street, but then, you look under the hood and your actual core organic business, it basically shrank by nearly 1%.
Yeah, it's a massive discrepancy.
It really is. So welcome to this deep dive into the Talk Tickers format. Today we're pulling apart the Q2 2026 earnings call for Brown & Brown.
Ticker symbol BRO for those following along.
Right, BRO. And our mission here is pretty clear. We want to break down all this corporate jargon and figure out exactly what it means for you, the retail investor, whether you're holding the stock or just eyeing an entry point.
Because there is a lot of noise in this particular market right now.
Oh, totally. We're looking at how this corporate giant is using accounting quirks, aggressive acquisitions, and literally a lack of hurricanes to mask some pretty serious issues.
Yeah, like a leaky talent pipeline and a stalling core engine.
Exactly. So we're diving straight into the numbers to see if this quarter was a blockbuster or, a bust, and we'll give you the 3 or 4 actionable takeaways you actually need to manage your portfolio.
The contrast between their press release headline and the actual underlying mechanics here is, well, it's striking.
I mean, on paper, total revenues hit $1.7 billion for the quarter.
Right, that massive 30.4% increase year over year.
And adjusted earnings per share came in at a call $1.77, which is up about 3.9%.
Yeah.
Plus, you have an adjusted EBITDA margin of 35.7%. So if you just glance at the terminal, it looks like a total blowout quarter.
It does, but you are looking at a mature insurance brokerage here. They are printing cash, sure, but they are also actively navigating some severe headwinds.
Right.
So 30% jump in top-line revenue for a legacy player in a consolidated sector that demands scrutiny.
Big time. And that brings us to the first major wrinkle, right? The organic growth, or the lack thereof.
Exactly. Separating the structural organic growth from the inorganic sugar highs is critical to actually valuing the stock.
Because that 30% top line jump, it's basically a guy showing off a flashy new sports car, right? Mm-hmm. But then you realize he bought the entire thing on credit. It was overwhelmingly driven by M&A.
Yes, specifically the integration of their recent Accession acquisition. They literally bought that revenue.
Right. And when you strip out that M&A stuff, their organic revenue actually contracted by 70 basis points.
And that 0.7% contraction, that is the exact metric institutional investors are zeroing in on right now.
Why is that one number so important?
Well, in the brokerage roll-up model, companies like Brown & Brown use their premium valuation to acquire smaller regional shops.
Or to get bigger fast.
Exactly. It juices the top line and gives them scale. But organic growth measures the actual health of the legacy machinery.
Like, are you actually selling more policies to more clients?
Yes. Or are you just bolting on new revenue streams from acquisitions to hide the fact that your core business is stagnating? And that contraction suggests the legacy engine is, well, it's stalling out.
But management was super quick to pivot away from that negative figure on the call, right?
Oh, absolutely. They argued that if you include what they call organic contingents, their organic growth actually flips to a positive 70 basis points.
Okay, we need to pause and translate that. Organic contingents, what exactly are those in plain English?
Right, so contingents are essentially profit-sharing bonuses. They are paid out by insurance carriers when a broker delivers a highly profitable, low-claim portfolio.
So basically, if the clients you insure don't have accidents or disasters, you get a bonus.
Exactly. But it feels a lot like building a financial forecast on meteorology.
Because you can't control the weather.
Right. They had a heavily storm-free quarter, especially in their specialty distribution segment, which earned them a surprise $9 million windfall.
And overall, those contingents jumped by an impressive $40 million this quarter, right?
Yep, with about $24 million of that coming straight from the new Accession business.
But that raises a massive red flag for me. What happens when the Atlantic hurricane season actually acts up?
Well, it creates a structural vulnerability in their earnings quality.
Right.
Because contingent commissions are inherently volatile. The carriers reward brokers for profitable underwriting, but if a hurricane hits, those profits vanish.
You literally cannot control the weather.
Yeah.
The analysts on the call push back on this?
They did. They pressed CEO Powell Brown on this exact point.
And what did he say?
He defended it. He said that looking at organic growth with the contingents included offers a cleaner comparison to their peers who, often don't break those numbers out separately.
I mean, I guess, but that just sounds like really convenient framing.
It is.
Yes, the contingents represent real cash flow. You can't just subtract them from the bank account. But factoring weather-dependent bonuses into your core growth run rate,
it completely obscures the actual sales momentum of the brokers on the ground.
Right. If next quarter brings a cluster of severe storms in the Gulf of Mexico, those profit-sharing bonuses evaporate.
And then the market is left staring at that underlying negative core growth. You absolutely have to price in that volatility when you're modeling their forward earnings.
Okay, so a shrinking core business masked by good weather. Let's look at the profitability, because that underlying pressure is showing up there too.
Right, the margins.
Yeah. Despite that 30% revenue boost and the $40 million contingent windfall, their adjusted EBITDA margin actually dropped.
Yes. By a full 100 basis points, it landed at 35.7%.
Which is, well, normally if you see a margin squeeze paired with skyrocketing revenue, you assume there's integration bloat. Right?
Or heavy operational friction from the acquisition, yeah.
So what's the story here? Was the core business failing on the margin side?
Not exactly. The CFO provided a highly specific accounting defense for that margin compression.
Okay, what was his excuse?
He attributed the 100 basis point drop primarily to lower interest income.
Wait, really? Interest income?
Yeah. Think back to Q2 of 2025. Brown & Brown was sitting on a massive pile of liquid cash because they were gearing up to buy a session.
Oh, right. And short-term rates were high, so that cash was just sitting in the bank generating a ton of interest.
Exactly. Fast forward to Q2 2026, that capital has been deployed, the cash is gone, so the interest income vanished with it.
Got it. So the year-over-year comparison just drags down the consolidated margin.
Right. It's largely a cash drag technicality.
Okay, I buy the accounting explanation for the interest income, but we can't let management blame the entire margin story on that, right?
No, absolutely not, because there is real operational bleeding happening.
Specifically within their retail segment. This is the most fascinating quirk in the whole quarter to me.
The startup defection drama.
Yes. They took an $18 million hit to organic revenue in this single quarter, because a group of their brokers basically jumped ship to a startup competitor.
And they allegedly breached their contracts in the process, which has triggered active litigation.
Which is wild. Why is losing one team such a massive financial hit?
Because talent retention is the apex risk in the insurance brokerage industry. The business model is fundamentally asset light. The primary assets are the relationships.
And those assets log off and go home every evening.
Exactly. When a high-performing production team leaves, they inevitably attempt to migrate their book of business, their clients, over to the new platform.
And management warned that this specific defection is going to cost the company a lot, right?
Yeah, they said between $50 million and $60 million in lost business and incentives for the full year of 2026.
Just from this one event. That is a brutal penalty for failing to retain a team.
It is. Yet the CEO tried to spin this as a positive on the call.
Wait, how do you spin a $60 million loss as a positive?
He claimed the event, quote, galvanized the team and offered an opportunity to bring in people with different capabilities.
You do not lose $60 million in recurring revenue and call it a team-building exercise. Come on.
Yeah, the spin was palpable, and you could tell the analysts weren't buying it either.
Really? Did they push back?
Oh, yeah. Elise Greenspan pressed for an update on their defensive hiring activity. Like, what are you doing to replace these lost producers?
And
Powell Brown became noticeably defensive. He just emphasized that their hiring strategy hasn't changed at all.
Which is concerning. I mean, the tension there highlights a broader macroeconomic shift in the labor market, doesn't it?
It absolutely does. Historically, this intense war for brokerage talent was confined to major hubs.
Like New York, Chicago, London.
Right. But now, with remote work architecture so entrenched, boutique startups can aggressively poach top-tier talent from legacy firms anywhere in the country.
And they can often offer superior equity splits that the big legacy firms just won't match.
Precisely.
So if I'm an investor, my big question is, are they just using that $40 million contingent windfall to paper over the fact that they're leaking core business to these scrappy startups?
That is the exact question you should be asking. You have to weigh that inorganic M&A growth against this organic talent bleed.
And on top of that, you have to weigh it against the pricing cycle, right?
Yeah.
Because the industry data they cited on the call was pretty rough.
Yeah, there are severe cross-currents in the macroeconomic pricing cycle right now. The most aggressive headwind is in catastrophe property rates.
Right. The cat property rates are basically tanking.
Free fall. They are dropping anywhere from 15% to 35%.
A 35% drop in pricing. That implies a fundamental restructuring of the capital markets backing those policies. What is driving that?
It's a classic oversupply dynamic. Global capital, like hedge funds and private equity.
Right. The alternative asset managers.
Yeah, they have flooded the reinsurance and excess and surplus markets. They are all seeking the high yields those premiums previously offered.
Got it. So when the supply of underwriting capital vastly exceeds the demand from commercial clients, the pricing just collapses to attract the business.
Exactly.
Okay, let's put that in plain English for a retail investor. If a client paid $100,000 last year to insure a coastal commercial property, they're paying, what, $65,000 this year?
Yep, assuming a 35% drop.
Yeah.
And because Brown & Brown collects a percentage of that premium as their commission.
Their commission drops 35% on that exact same policy.
Right. So they are effectively running on a treadmill. They are forced to originate 35% more policy volume just to maintain a flat revenue line.
That sounds exhausting. That volume requirement has to put immense strain on their sales force.
It does. And during the Q&A, analyst Mark Hughes tried to pin the CEO down on when this pricing floor might actually materialize.
Did he get an answer?
Not a reassuring one. Brown refused to call the bottom. But he did provide a sobering threshold for what it would take.
As the threshold.
He stated it would take an industry-wide loss event of $100 billion to $150 billion to fundamentally alter the capital dynamics and force rates to harden.
Wait, so he is essentially saying it requires an unprecedented catastrophic event.
Yes. Something that wipes out massive amounts of underwriting capital to flush all that excess supply out of the system.
So until a highly populated area takes a historic direct hit from a hurricane or something, the capital remains abundant and broker commissions remain suppressed.
That's the reality of the property market right now.
Wow. But it's not all bad news, right? The brokerage model does benefit from diversification.
Yes, thankfully. While property rates are a heavy drag, the employee benefits sector is actually providing a substantial tailwind.
Because healthcare costs are going crazy. The call highlighted that medical costs are sustaining an 8 to 10% inflation rate.
And pharmacy costs are surging past 10%.
Right. So when healthcare costs compound at double digits, corporate HR departments start to panic.
Naturally.
And they require aggressive restructuring of their benefit plans, which drives immediate demand for Brown & Brown's advisory and consulting services.
Precisely. They are monetizing the complexity of the healthcare system. They aren't just placing a product. They are architecting a mitigation strategy for a massive corporate liability.
And that consulting revenue is highly sticky, right? Which helps offset the transactional drag from those falling property rates we just talked about.
It does, but we should also address the anomaly in their specialty distribution segment.
Oh yeah, the numbers there looked a bit weird.
Yeah, excluding the contingents, organic growth in that specific division was negative 3.5%.
Which, for a segment designed around high margin, bespoke risk placement, looked like a pretty significant operational miss.
It does look bad on the surface, but the CFO intervened to contextualize that figure.
What was the context?
He noted it was temporarily depressed by about $10 million in delayed new business revenue.
Oh, tied to a specific program, right.
Exactly. The business was secured, but the accounting recognition just slipped into the third quarter.
Okay, so if you normalize the quarter for that $10 million timing delay, the segment's trajectory aligns much closer with their historical averages.
Right. But that specialty segment is also navigating a really profound migration of risk right now.
Migration between what?
Between the admitted markets and the excess and surplus, or E&S markets.
Okay, yeah. We saw data out of Florida indicating a massive volume of commercial property risk is fleeing the admitted carriers. Why is that happening?
The rigid regulatory structure of the admitted market is fracturing under the complexity of current climate and litigation risks.
Because admitted carriers have to file all their rates and forms with state insurance commissioners, right?
Yes. They lack the agility to dynamically price these rapidly emerging risks, so their default defensive posture is just to shed the exposure entirely.
So they drop the policies.
Yeah.
And then the E&S market steps in to absorb that discarded risk.
Exactly, because the E&S market possesses the freedom of rate and form. They can customize the exclusions and demand a premium that accurately reflects the real risk profile.
But for a broker, Navigating that migration like transitioning a complex commercial client from a dropping admitted carrier into a fragmented E&S syndicate, that has to be highly labor intensive.
It is intensely complicated. It requires serious technical underwriting expertise, which, justifies their high margin, but it also really extends the placement cycle.
Got it. Okay, so with that complex operational backdrop established, we've got M&A masking flat core growth, the talent defection, the property rate free fall, and this complicated E&S migration.
It's a lot.
It is a lot. And knowing all of that, management's guidance for the rest of 2026 feels surprisingly optimistic.
It really does. They are projecting retail organic growth, excluding those volatile contingents, to land between 1.5% and 2.5% for the second half of the year.
And for specialty distribution, they're guiding for 2 to 4% organic growth?
Yeah.
I mean, they just printed a negative 0.7% core organic growth quarter, and they are instructing Wall Street to underwrite a rebound to as high as 4% in the back half of the year.
It's a bold projection.
That requires a massive operational pivot, especially considering they're still dragging the anchor of that $50 to $60 million startup defection penalty through the end of the year.
Right, but they are modeling that rebound on 3 specific catalysts.
Okay, walk us through them.
First, the immediate recognition of that $10 million in delayed specialty revenue in Q3 that we just talked about.
Sure, that's easy math.
Second, they are heavily promoting a newly implemented go-to-market sales model.
A go-to-market sales model.
Yeah.
That sounds like corporate jargon.
It is, but they argue that restructuring their regional leadership will unlock cross-selling velocity across their newly acquired Accession footprint.
Meaning they think they can sell more existing products to all the new clients they just bought.
Exactly. And third, their guidance assumes the property rate environment will not deteriorate beyond the current 35% contraction floor.
So they're betting it won't get any worse. Speaking of the Accession integration, though, they reaffirmed their target of $30 million to $40 million in integration synergies for the year, right?
They did. That suggests the back-end consolidation is tracking nicely to the spreadsheet.
But expense rationalization is the easiest part of an acquisition to execute, isn't it?
Oh, absolutely. Collapsing redundant software licensing, consolidating regional headquarters, eliminating overlapping admin headcount, that all provides immediate margin relief.
But the true test of the Accession deal's valuation is going to be revenue synergy.
Exactly. Can they take a proprietary construction liability product developed by Accession, for example, and successfully distribute it through Brown & Brown's massive legacy retail network?
Right. Hitting that $40 million synergy target implies they are capturing both the expense cuts and the initial cross-selling momentum.
Which brings us to the strategic wild card of this earnings call.
Oh, yes. The AI name drop.
Yes. Management dedicated a really significant portion of their prepared remarks to their AI integration strategy.
They announced formal partnerships with Anthropic, McKinsey, and Accenture to, quote, rewire their core business processes.
Specifically targeting sales, placement, submissions, and underwriting.
Okay, but I have to ask, is this just standard corporate AI bingo to juice the stock price? I mean, literally every company mentions AI now.
Yeah. It is the most compelling strategic narrative on the call, actually. Yes, mentioning an Anthropic partnership is standard operating procedure for investor relations right now.
Right.
But Brown & Brown differentiated their approach through their capital allocation strategy. Management stated they anticipate 0 incremental technology spend to fund this entire AI rollout.
Wait, you do not retain McKinsey and Accenture and integrate enterprise-grade large language models for $0.
Exactly. The financial engineering here is the real story.
How are they paying for it?
They claim they are funding these massive AI architecture builds purely through budget reallocation.
So they're stripping capital away from legacy IT maintenance, so what they call running the business, and redirecting those exact same dollars toward data analytics and AI deployment.
Yes. It is a ruthless prioritization of capital. Instead of treating AI as an additive capital expenditure that degrades current margins, they are literally cannibalizing their legacy analog processes to fund the digital transition.
That is pretty genius financially. But let's look at the actual mechanics of what McKinsey and Anthropic are building for them. Because insurance brokerage is an industry suffocating under unstructured data.
Oh, it's a nightmare. You have brokers dealing with 100-page PDF loss runs, disjointed policy schedules, archaic carrier submission portals.
Right. The operational bottleneck has always been data ingestion.
Historically, brokerages spent tens of millions of dollars annually on administrative headcount simply to manually key data from a PDF into a proprietary underwriting engine.
It's so manual. So the LLM integration fundamentally alters that pipeline.
Entirely. The AI model ingests the unstructured PDF, normalizes the risk data, cross-references it against carrier appetites, and formats the submission automatically.
That's huge. But Powell Brown made a highly astute observation during the Q&A regarding the timeline for monetizing this, right?
He did. While the broader market is treating AI as an immediate EBITDA expansion tool, he cautioned that the true financial benefits, the structural margin expansion, won't materialize until years 3, 4, or 5 of the integration.
So he's actively managing expectations.
Yes. He is pricing in the friction of user adoption and the hidden costs of compute.
Oh, the tokens.
Right. He explicitly warned that the industry does not fully comprehend the ongoing variable costs of tokens.
Which is the computing power required to run inference on these models at an enterprise scale.
Exactly. And he also highlighted the behavioral risks, noting anecdotes of employees at other firms utilizing corporate AI licenses for personal projects on company time.
Wow, so people are writing their screenplays on the company's Anthropic dime.
Basically. So to counter that, they expanded their value management office to enforce strict governance over these AI pilot programs.
Meaning every deployment must have rigid KPIs and quantifiable value drivers.
Yes. They are operating on a fail-fast methodology. They are refusing to commit structure.
Highly disciplined, conservative approach to a technology that is currently just drowning in hype.
And it perfectly reflects their broader corporate DNA. They are willing to modernize, but they refuse to compromise their current cash flow generation to do it.
Which transitions us perfectly to the bottom line.
The most actionable part.
Right. We have translated the accounting quirks, quantified the talent bleed, evaluated the M&A masking, and analyzed their disciplined AI rollout.
So what are the strategic implications for you, the investor? How do you actually position this stock?
What's your take?
The thesis rests entirely on their liquidity. In just the first 6 months of the year, Brown & Brand generated approximately $610 million in operating cash flow. Cash
is king. That is a 13% increase compared to the first half of 2025.
It's staggering. Generating $610 million in pure cash over 2 quarters provides an impenetrable shock absorber for the business.
It means they're not beholden to the credit markets to fund operations.
Exactly. They can comfortably absorb a $50 million revenue hit from a rogue broker team, and they can weather a multi-year trough in property pricing without ever touching the principal of their balance sheet.
So, taking the entirety of the operational data and the macro environment into account, where do we land?
The setup warrants a cautiously bullish stance.
I agree. Despite the annoying leakage from the startup defection, which is a severe operational failure.
Yes, it is.
And the macro headwinds compressing property commissions, which are actively degrading top-line momentum, the stock is a solid hold or cautious buy for long-term retail investors.
The primary driver behind that cautiously bullish rating is management's capital return strategy.
Yes, the buybacks. They deployed a massive $500 million to retire 9 million shares over the last 9 months.
And retiring 9 million shares at current valuations sends a definitive signal to the market.
It implies management believes Wall Street is mispricing their E&S upside and undervaluing the long-term margin expansion they expect from the Accession integration.
Furthermore, executing a $500 million repurchase program establishes a concrete floor beneath the equity.
Right, because if macro volatility triggers a sell-off, management just steps in with that $610 million in operating cash flow and absorbs the outstanding float at a discount.
Artificially stabilizing the price action.
Exactly. And when analyst Roland Mayer questioned the CFO about an upcoming $400 million debt maturity schedule for December, the response was incredibly telling.
Oh yeah, the CFO completely dismissed it as a non-issue.
He cited plenty of optionality due to their cash generation.
They are operating from a fortress balance sheet.
Okay, let's wrap this up. To distill this earnings deep dive into the critical takeaways for you. First, recognize that the 30% top-line revenue surge is heavily synthesized by the Accession M&A.
Right, the core legacy business is grinding against zero growth.
Second, management is leveraging a weather-dependent spike in contingent commissions to mask that underlying stagnation.
Third, their operating cash flow is exceptionally robust, which provides the strategic flexibility to navigate the property rate collapse and the internal talent defection.
And fourth, they are aggressively utilizing that liquidity to retire equity, shielding current shareholders from broader market volatility.
They are essentially a legacy compounder fighting through a very messy transition period, digesting a massive acquisition while fending off boutique poachers, but they're executing this transition with bulletproof financials.
Which leaves us with a final, critical, and somewhat provocative question for you to monitor in the coming quarters.
Yeah, this is the big one.
We praise their disciplined approach to funding their AI architecture purely through budget reallocation, maintaining a zero incremental tech spend.
But in an industry fundamentally predicated on data velocity and analytical precision, how long until that reallocation well runs dry?
Exactly. It is the defining risk to their margin profile. You can only hollow out your legacy IT maintenance budget so much before you hit structural bone. So the provocative thought here is whether Brown & Brown will eventually be forced to abandon this conservative stance. Will they have to authorize substantial, unbudgeted capital expenditures just to keep up with leaner, tech-forward competitors who are building native AI workflows from the ground up?
If they are forced to suddenly deploy hundreds of millions into cloud compute and token inference to survive, what happens to that precious 35% margin?
It compresses rapidly. Keep a very close eye on their technology capitalization rate in Q3. Thanks for joining us on this deep dive.